Hello everyone and welcome back to the podcast. I continue to study Netflix because I believe it reveals how we can make 400 times our money on the stock market and then some. And it sounds like an unreasonable amount, but if you study Netflix's history and the fundamental components of this business, the qualitative aspects of it and so forth, you will realize that it's the same aspects behind Netflix leading to this 400x plus return that is behind other great businesses of our time, like Amazon, Walmart, Costco, Palantir and Spotify, in my opinion now, and so forth. And so let's get deep into this session, which is an update of my original Netflix deep dive. This is a Q2 2024 earnings report update, so let's get into it. Netflix holds one of the more valuable lessons one can come across in the stock market, namely that buying a company that is obsessed with the end customer and is constantly iterating and optimizing its products tends to yield excellent long-term returns. Further, that despite bouts of fundamental underperformance and resulting pessimism in the stock market, the company will likely find its way back to excellence. As you can see on the screen now, Netflix stock is up over 250% since the market temporarily decided that the company had lost its way. IPO, initial public offering investors, so those that bought just at the start, and that sold in April 2022, missed out on an additional 41,000 plus return, which they would have obtained by simply holding on to the stock for another year. The stock price increase has ultimately been driven by Netflix's rising operating margin, which in Q2 2024 came in at 27.23%, up from 7% in Q4 2022. What's fascinating is that selling Netflix in early 2022 was a seemingly rational and well-informed idea by all traditional standards. Further, operating margin trending to all-time highs in the last 2 quarters is ironically merely the result of Netflix simply carrying on with its operations. Digging into the Q2 2024 earnings call reveals that the main drivers have been a strong content slate and getting better at yielding business value, 2 extraordinarily normal aspects of Netflix's operations. For all the complexity involved in most quantitative analysis, IPO investors that sold in April 2022 left an additional 41,000% return on the table, as I was saying, because they didn't understand at that time that Netflix would bounce back by simply being Netflix. Hence, what this scenario reveals is the importance of deep qualitative analysis in order to achieve and protect extraordinary long-term returns. Here's what co-CEO Spencer Newman said about this topic during the Q2 2024 earnings call about the revenue growth.
In terms of growth generally, there's probably kind of 3 key factors that drove member growth. First, strong performance of our content slate, the wide variety of titles that delivered across genres and regions, and I'm sure we'll talk more about that. There was some positive impact from paid sharing that continues. As we've said on recent calls, it's tougher and tougher to tease that out. We're clearly seeing healthy organic growth in the business, but we're also continuing to get better and better at translating improvements in our service into business value, including getting better and better at converting unpaid accounts.
There is no way one could have foreseen this by only looking at the numbers in 2022, but it is reasonable to ascertain the causality between a real focus on the end customer and on eventually printing great financials again. The main premise behind all of my investments, or at least the successful ones, is that companies that are organizationally excellent eventually yield world-class financials down the line because they tend to find new ways to bring value to the market at a defensible margin. This has certainly been the case with Netflix and continues to be the case. The entertainment business consists in aggregating creative talent and having them work together based on a series of rules, otherwise known as culture. By protecting the autonomy of creatives and enabling executives to reliably franchise, in turn, entertainment businesses yield IP, intellectual property, and means to distribute it effectively to an audience. Over time, this equates to entertainment, which if good enough, equates to free cash flow. None of the components that you see in the graph below went markedly wrong during the 2022 period. Netflix saw higher levels of competition and arguably went through an IP cold streak, but a review of this mental abstraction that could have saved many investors from jumping out of a true compound. Of course, this analysis has the benefit of hindsight, but I keep thinking about how a deep qualitative analysis helps you better identify seemingly undervalued businesses at a given point in time, and then once you buy them, not be scared out of these positions and sell these positions just because the market throws narratives at you. When I first studied Netflix, which is recently just after the stock price decline in 2022, I wasn't sure myself whether it would bounce back up or not. But I did identify various components of the business that did make me feel like the market was maybe throwing a little bit of a tantrum. However, the question remains how to spot a company that is organizationally excellent. And this is essentially the main question that I answer in my Tech Stocks Goldmine course. In practice, these companies solve a growing volume of acute customer pains in a way that is increasingly harder to imitate at scale and profitably. The market thought Disney Plus and others could eat Netflix's lunch, but the former bunch simply could not imitate Netflix profitably. They definitely have proven to be not as efficient in terms of their machinery in creating IP, distributing it, creating profits, and then reinvesting capital back into that infrastructure in order to compound membership, essentially. They're just not that good. They're not that focused on the task at hand. During the Q2 2024 earnings call, management laid out Netflix's competitive advantage very clearly. They have creative teams spread out over the globe, attempting to produce local hits. Sometimes these local hits become a global phenomenon, returning many times their original investment. Netflix then reinvests this money to keep the flywheel spinning. In turn, Netflix constantly improves all aspects of their platform and content slate to further accelerate the flywheel. As I was saying, it turns out that Netflix's focus on the above infrastructure is superior to that of its competitors, and so its overall capital efficiency is higher. Netflix is marginally better at producing hits and enhancing the user experience of its platform, such that over time, this translates into an unfair advantage. Every dollar Netflix reinvests simply translates into more value for the end customer. As I was saying, of course, this analysis has the benefit of hindsight. I am not a Netflix shareholder, I have never been one, and therefore this is not really my game to play. I am simply analyzing Netflix in order to learn more about how to pick good stocks and hold them for the long term. This case study serves as further validation of the method I use to spot undervalued companies with huge potential. Quantitatives are essentially the tip of the iceberg, while qualitatives hold the vast majority of the information required to obtain truly excellent returns. Further, IPO investors that sold in April 2022 did not only leave an additional 41,000% return on the table, but are also likely to miss out on future returns. Indeed, Netflix has not only bounced back, but now is gearing up to continue producing astounding returns over the next decade. I explained in my original Netflix deep dive, as you can see in the graph below, how increasing the profitability of this business essentially consists in producing more IP, again intellectual property, and increasing the surface area via which you distribute the IP, so to increase the amount of money the company makes per unit of IP, again as depicted in the graph below. If you find a way to multiply the surface area, you can yield a non-linear value increase of the business. And I learned this by studying Disney. And Disney started off with, the story is very long and full of ups and downs along the way, especially at the beginning. But essentially, Disney's history is about figuring out new and better IP and then figuring out ways to increase the surface area via which the IP gets distributed. So namely, one great example of that was the theme parks. Disney started making serious money once they launched the theme parks. And all they did was increase the surface area via which Disney could distribute their IP. Because essentially, if you think about it, the theme parks, they enable customers to immerse in the IP and spend time there and drink stuff and eat food and so forth. And so the theme parks are really the ultimate way of increasing the amount of time the average end customer of Disney spends engaging with the IP. More importantly, as it refers to Netflix, Netflix moved into games 2 years ago and has now released more than 100 of them. 99 games are currently being developed as of Q2 2024, and while the end result of the business is still financially uncertain, we know, per management's comments in the Q2 2024 earnings call, that Netflix is executing the same playbook it has achieved great success with in the production and distribution of its originals. Qualitatively speaking, therefore, the game business is powered by underlying drivers that are likely to equate to success. Here's what co-CEO Greg Peters said about this during the Q2 2024 earnings call.
I think you've seen this trajectory with us before, whether it's been a new content genre like unscripted or film, or maybe getting the content mix right for a particular country. You can think about Japan or India, which we're now in an amazing place through the hard work of our teams there. We continually iterate, we refine our programming based on the signals we get from our members. And if you look over several years with that model, we can make a huge amount of progress.
Further, the game and the original production verticals, so the movies and the series and so forth, are now set to compound each other. Games can further grow fandom, which would spill over into the series and movies and vice versa. And then we know that people like to spend a lot of time gaming, and so what this does is, if you have the average fan of a given series, that fan spends a lot of time watching the series and then spends even more time playing the game. So what happens is that this new vertical not only promises to increase the revenue per unit of IP, but also promises to decrease the cost of acquisition for Netflix, because then people invite their friends to the games and then they spend time in the game with their friends, which tell other friends and so forth. Additionally, every further vertical beyond the gaming business should continue to compound this dynamic. So my view is that so long as Netflix stays organizationally excellent, which again, I discuss in my course how to spot when a company is organizationally excellent and when it remains organizationally excellent, the future looks very bright for shareholders. So thank you very much for joining me. If you did enjoy this update, can I please ask you one favor as always? Please share this with one friend whom you think will enjoy this. These deep dives are for free, and so the only way this grows is with your help. So thank you very much, take care, and until next time.